We are now live. I'll just give it a moment, let people join, and then we'll get started. Right, I'm sure people will continue to fill in over the first minute or so. I see a join. We'll go ahead and get started. Like I said, I'm sure people will continue to join, but I'd like to say welcome everyone. Good afternoon, and thanks for joining our Q1 2025 Financial Markets and Portfolio Update webinar. We're happy to have you join us today. As always, we're looking forward to a great conversation with Steve about what's happening in the markets and our portfolio strategies and the economic factors playing a role in the year ahead. So we are joined by Steve Galley, our Chief Investment Officer, who leads these quarterly market updates. Steve always brings great insight and perspective to what's going on and what we should be paying attention to. So we're excited to hear his insights today. And with that, I know there's always a lot to go over, so we'll get started. And Steve, I will hand it over to you.
Thank you, as always, Katie, and thank you all for joining. I hope this proves informative and interesting, and we always look forward to your feedback. I do want to cover one quick housekeeping item. As you all know, we always try and have time for questions and answers at the end, but due to the fact that Zoom, which is the product we're using to conduct this webinar now, does not support archiving for compliance purposes of the chat function, we can actually no longer accept questions submitted by the chat function. But at the end, we will open it up for live Q&A if anyone wants to actually ask a question verbally, and we will do our best to address it then. And I also want to thank people who submitted questions in advance, which we love to see those. We did get a bunch of those, and I will also do my best to address those during the presentation, if not at the end of the presentation. So with that, let's get into it. As always, we will be covering, what's going on out there in the markets, and of course, there's no shortage of headlines about that. Then we'll discuss, what that means for portfolios and investments, and then at the end, of course, the Q&A. So I always like to go through some of the current headlines, but taking a walk down memory lane, this is actually a headline that appeared about a year ago in the Wall Street Journal, and it was all about AI. And how AI was starting to threaten certain jobs and making people worried about their future employment. And interestingly enough, the conversation about AI has only gotten more prevalent today. This is actually a recent headline from Barron's a few days ago about how everything AI, especially stock-wise, is getting very, very expensive. And are we in a bubble? Wall Street Journal talking about inflation. It's still a problem. We'll be talking more about that. And then, of course, there's a lot of talk about tariffs or potential tariffs and what that will have in terms of an impact on both our economy and the markets. And finally, a recent one from Bloomberg saying how corporate America's profits, their future outlook is perhaps a little cloudy and maybe not as rosy as everyone thinks it is. A sub-headline in that article was that despite the fact that fourth quarter earnings were really good, and we'll talk about that, there's a concern that they won't be as good as we get into the earnings results in 2025. And sure enough, what just happened? Well, Walmart actually just reported earnings today, and they were disappointing. And so that's not good, considering that Walmart is actually today the largest grocery by revenue in the entire country. So they're sort of a harbinger of what may or may not be happening in terms of, consumer health and spending. Okay, so let's talk about what happened last year as well as what's going on this year. So actually this year, the markets have started off pretty darn well. And that's even after a really great 2024. And, in the In the slide here, I highlighted, highest to lowest, what happened in the last 12 months for various market sectors. And as you can see, really the top two sectors that have done really well in the last 12 months, well, it's been growth stocks and it's been technology stocks. Even after 2023 was all about growth and tech, 2024, once again, was all about growth and tech. Value stocks didn't quite keep up. And the bond market, actually, we were expecting bonds to actually have a kind of a better year. They didn't have such a great year because despite the fact that the Fed was cutting interest rates, yields, especially on the long end, went up. And when yields go up, bond prices go down, which can impact their returns a bit. So, and then in terms of starting off the year, markets are still up. On an annualized basis, it's only been about a little more than a month and a half. I mean, if we annualize those returns out, we could be looking at another double-digit return year, although I would be a little suspicious about that. I don't think it's going to play out that way. So one thing, though, that is really important to think about is, oh my gosh, if the market is close to all-time highs, which, by the way, the S&P 500 actually hit an all-time high yesterday, that doesn't mean it's not a good time to invest, right? Because in a way, all-time highs beget new all-time highs. Momentum is really what can occur. And so what the chart, especially on the right, that I think is really interesting, it kind of shows that even when you invest, when the market sets an all-time high, right, your future returns are actually stronger than if you didn't invest on a day that was at an all-time high. The point is, as we always try and tell clients, it's really not timing the markets. It's about time in the markets. And as we know, over the long term, equities do always return long-term investors in a positive way. So if you are sitting on the sidelines and are worried about how expensive things are, what this chart is telling us is it doesn't necessarily mean sitting on the sidelines pays off. So that being said, on average, households in this country have a very high allocation to stocks. And that's obviously no surprise, especially after we've had several strong years of equity returns. People who have owned stocks now see an even greater percentage of their wealth concentrated in the stock market. And that's basically showing at the expense of they're owning less debt and holding less cash. Now, that could be a worrisome thing from the standpoint that if people panic, well, there's a lot of people who own stock out there, and if a lot of people start selling, maybe that would create some downward pressure on the market. So where do we go from here? And a lot of the research that I like to read is put out by Goldman Sachs. I think they've got a lot of great researchers who do really interesting papers on all these types of things. And basically, Goldman Sachs thinks that earnings this year will go up around 10 to 11%. And if they think earnings this year will go up by that amount, that's actually a reasonable proxy for their guess as to where the market will end up the year. So basically, Goldman Sachs put out a piece that said they expect the S&P to reach 6,500 by the year end. And if that actually plays out that way, that would mean that the S&P 500 this year would return approximately 10%. So Goldman Sachs is not necessarily bearish at all this year. And again, they come up with those forecasts because it's all about what the companies you're investing in deliver in regards to profits. So, and as you can see, when we came out of, the year 2022, which actually was quite a negative year for the market, it took a while for earnings of companies to recover. We actually had 3 consecutive quarters of negative earnings until they started to turn positive in 2023. And then, of course, as they turned positive, the market really predicted and enjoyed that. And that's why 2023 was a good year in the market, as was 2024, because the market loves earnings, especially earnings that come in higher than expected. So And that's exactly what played out in the last couple of years. And that's exactly what Goldman is forecasting for 2025. They actually think that on average, earnings will return just above double-digit returns, which is why they're somewhat excited about the prospects for stocks and equities in 2025. That doesn't mean, though, that things aren't expensive. Things are very expensive right now. If you think about how much you have to pay for a stock, that's usually expressed in terms of valuation, expressed in terms of a price to earnings ratio. In other words, what am I paying versus what is the expected earnings of what I'm paying for? That's the price to earnings ratio. And right now, on average, it's pretty high, meaning for every dollar of earnings that I think a company is going to deliver, in order to buy that dollar of earnings, I have to pay 22 times that dollar, right? And when you look at actually an equal weighted index, and I'll get to that. So what that means is the S&P is a market cap weighted index. What does that mean? It means that if Apple, which is the largest company by market capitalization in the world right now, Apple is weighted a much bigger percentage in the S&P 500 than, let's say, John Deere, the iconic green tractor maker. And so therefore, if Apple stock goes up this year, it will have a it will have a proportionate effect on the S&P relative to its weighting, which is quite large. On an equal weighted basis, meaning let's say that every stock in the S&P had the exact same weighting, right? So 500 stocks, if they all make up the S&P, that means each stock would be weighted at 0.25%. Or I should say 20 basis points, or 0.2%. On an equal weighted basis, things aren't as expensive, meaning a lot of the over expensive stocks are concentrated in those larger market cap stocks, not so much so on some of the smaller stocks in the S&P 500 universe. So that's important in terms of some of the things we're thinking about in terms of allocation. And if you think about it, is a 22 PE ratio unusually high? Well, yes. So I think it's pretty interesting. Goldman takes a look at, if you look at the blue bar is kind of, where 2/3 of the time valuations fall, you can see that a 22 PE is way above the normal valuation experience that we have over time. But if you look abroad, the stock 600 is kind of like the S&P 500 of Europe. Valuations are actually very average. Same thing with Japan, and same thing with Asia Pacific in general. So the point is that not everything is expensive, but the US definitely is expensive by historical standards, and certain parts of the US market are even more expensive than usual. And as I was saying, if you think about it, some of the biggest stocks in the S&P, which is they've been referred to sometimes as the Magnificent Seven. The Mag 7 includes Apple, Nvidia, Microsoft, Amazon, Tesla. They trade at a much higher multiple than the rest of the index. So part of the thinking is, if possible, it's perhaps prudent to shift away from some of those high multiple, big tech, big growth stocks into some of the more reasonably priced, value-oriented stocks. And to support that point, what Goldman's telling us right here in terms of annual earnings growth is they expect, one of the reasons that the Magnificent Seven has done so well is because their earnings have been so much better than most other companies. They've actually delivered on earnings expectations. But moving forward, that's going to be harder and harder to do. It's very difficult for companies to continue to outperform. Why? Well, competition. If you have a great margin business, other people want to get in on those nice margins, and they will try and chip away at your dominance. And that is what Goldman is certainly expecting to play out. I think that makes perfect sense, in the sense that it will start to normalize a bit, where the rest of the non-Magnificent Seven start to catch up, and the Magnificent Seven starts to normalize towards the rest of the crowd. And so basically what that means is that being equal weight in terms of market cap weight might be a smart place to go. The equal weighted S&P 500 index has beat the market cap weight index 78% of the time over, any 10-year period over the last basically 60 to 70 years. So one of the things that I'll talk about later is that is why we are shifting some of our allocation to more equal weighted exposure to equities versus market weight exposure. And this slide really talks about, the outrageous total return numbers that we saw from the Magnificent Seven stocks last year. Although this year, and this is through early February, it hasn't played out that way. As a matter of fact, the Magnificent Seven stocks in general have lagged the rest of the market, which means that perhaps this is already starting to play out a little bit in the sense that maybe it is already starting to normalize, where the valuations of the Mag 7 are coming down a bit versus the rest of the market starting to catch up. So when we talk about tariffs and trade policy, and I know someone asked a good question about, our potential thoughts about the impact of the administration's tariff policy. The Magnificent Seven also has the most exposure to sales outside of this country. As a matter of fact, almost half of the Mag 7 sales are derived from countries outside of the United States. That means tariffs will probably impact them disproportionately relative to other companies. Yet another reason why it probably makes sense to shift away from those mega cap names where possible. Now, as we always talk about, our economy in general is powered by the US consumer. About 2/3 of our economy is dependent upon the consumer health and consumer spending. So it always makes sense to take a look at how is the consumer doing. And so if we look at sort of 6 metrics around the consumer, everything from the level of their wealth to whether they're employed to their confidence level and how much they're spending, in general, we can see that if you look at, and by the way, the blue bar is kind of the average number that you would see over time for all of those 6 metrics. In general, the consumer's looking pretty good. People who want to be employed pretty much are employed. There's very low levels of debt relative to history for the average consumer. And more importantly, the consumer is sitting on more wealth on average than they usually have. Part of that is what's known as the wealth effect. After we've had several years of very strong markets, people's accounts are bigger than they used to be. And that has actually been one of the reasons why inflation has proven to be sticky and not come down, because people, what do you do when you're sitting on a lot more wealth? Well, you travel, you take trips to nice places, you buy tickets, you rent cars, you stay in hotels, you eat out. So services inflation has remained very, very high. And a lot of that has to do with the nice wealth effect that we are seeing with consumers, especially in the upper economic categories. Now, I think perhaps we need to be realistic about what makes sense to think about what equities will do over the next, not just year, but maybe the next 10 years. And, looking at, this is another piece from Goldman Sachs talking about what do they think equities will do over the next decade. And the sobering reality is that based upon where equities are today and where they think earnings are going to go over the next several years, they actually think it's more realistic to assume low single-digit returns for stocks over the next 10 years. In other words, their baseline forecast is about 3%. Certainly nothing compared to what we've experienced in the last 10 years. Now, of course, that depends on a lot of variables that may change. And Goldman themselves say that has a 5% margin of error. That could be anywhere from, plus 7 or 8% to -1 to 2%. But the bottom line is, after we've had such strong returns, especially in the equity markets, I do think it makes sense for all of us to perhaps temper our expectations a bit moving forward. And so that actually gets to valuations. Everyone knows I always like to look at this chart provided by our partners at JP Morgan. And this is actually 2 years ago. So in a walk down memory lane, when we were doing this webinar 2 years ago, we made the observation that, things are getting a little expensive, but still not that expensive, still well within, kind of historical expectations in terms of stock valuations. 2 years ago, we were trading at around 18 and a half on a price to earnings basis, right? Then a year ago, as we were sitting here doing this, things were getting uncomfortably expensive. We were at a 20 PE ratio. And back then, we thought that perhaps it made sense to be a bit cautious. And to be fair, and to call a spade, it didn't pay off to be cautious at the beginning of last year, because last year was an awesome year for the stock market, because here we are today, and stocks are even more expensive. Now they are trading well over a 22 forward PE multiple. So if we thought that it made sense to be cautious a year ago, we do think it certainly makes sense to be cautious now. But not everything is super expensive, right? And so we always talk about the difference between growth stocks and value stocks. Right now, if you look at, and I think this chart is interesting in terms of looking at, is value cheap relative to growth, or is growth expensive relative to value? What this is basically telling us is those big tech growth stocks are expensive relative to value, to the point where actually maybe value is a much more reasonable place to be moving forward, or at least emphasizing value. Looking at it in another way, the forward PE ratio of the average pure growth stock is about 30x, which is exactly as we saw what the Magnificent Seven in general were trading at. Whereas the average forward PE for value stocks is only a little below 13. So that tells me that if we are going to try and be smart about where to move away from where things are expensive into where things are a little less expensive, or even more close to average or below average price, value might be the place to be. Not only that, I'd be remiss if I didn't talk about how relatively inexpensive international stocks are compared to the US counterparts. And on the left-hand chart, it's basically telling us that over the last 20 years, international stocks are in rarefied, cheap territory, meaning rarely have international stocks been this inexpensive relative to their US counterparts, right? So if we are thinking about where it makes sense to allocate, we do not want to ignore the fact that international stocks compared to US stocks are much more reasonably priced. And if we are expecting this year to not necessarily be as good as last year, which I think is a reasonable expectation, then it makes sense to lean more into areas that are at more reasonable price points. Taking another walk down memory lane, let's not forget that 3 years ago, this is what the yield curve looked like, right? If you bought a 1-year treasury bond from the government, you didn't even get 1% back. If you gave them your money for 10 years, you were barely even getting 2% back. Now, for those of us who were actually getting mortgages back then, good for us, because we locked in really low long-term mortgage rates thanks to this incredibly low interest rate environment. But 2 years ago, we saw the yield curve invert. And that's when the Fed had a big inflation problem and they began hiking up short-term rates. So then a 1-year treasury bill would get you closer to 5%, right? And the 10-year treasury also moved up. That was getting you closer to 3.75%. A year ago, the yield curve was still inverted, but the 10-year was even higher, despite the fact that the Fed had hiked rates several times. And why is that? That is because they really were having a hard time getting rid of inflation, and the bond market hates inflation. So long rates actually creeped up, and short rates actually crept up even more, so that the 1-year was giving you still what it gave you, but even on the shorter end, it was higher, because the Fed had to keep jacking up rates because inflation was still a problem. And here we are today. What happened? No more inversion. Now, the yield curve has always been a great predictor of a recession. When the yield curve inverts, that almost always means we're going to have a recession. That actually didn't happen. Despite the fact that we saw that the yield curve was inverted not just 2 years ago, but also last year, the recession that the yield curve usually would predict never occurred. And so basically the yield curve said, well, I guess we were wrong, and it de-inverted. So now on a 1-year treasury, you're not even getting close to 5%. You're lucky to get, 4.25. The 10-year though is now at 4.5. And so since many mortgage rates are benchmarked off the 10-year treasury bond, usually at least a plus 3%, that's why mortgage rates are around 7.5%, because that's where the treasury is. So you are getting paid more to go out further on the maturity spectrum. So if we actually look at the red line is what it looked like a year ago and the blue line is today, we can see that longer rates are even higher than they were a year ago, and shorter rates have come way down. And that's because the Fed, as we all know, began to cut. But they haven't been able to cut as much as everyone hoped. And why is that? That is because inflation is still a problem. Now, if many of you remember, post-pandemic, we had this massive spike in inflation in the middle of 2022. Inflation was running at almost double digits. And that, of course, the Fed had to go on a massive hike campaign to try and tame inflation, which they did to some extent. But the Fed's inflation target is 2%. And they have not gotten anywhere near that 2% target. As a matter of fact, the print that came out, I believe on February 12th, inflation actually ticked up. So the Fed is basically telling us, and has been saying this, that they're probably not going to cut much, if any, this year until that inflation number shows signs of improving and getting back to that long-term 2% run rate. And again, with that wealth effect happening in terms of services inflation, I think that's going to be very hard to achieve. And so what has that meant for the bond market? Well, it kind of means that the bond market has taken that in stride. So what this shows us is that corporate bond spreads. What's a spread? Well, if I buy, let's say, a John Deere bond, right? Maybe John Deere wanted to build a new factory to produce nice new green tractors, and they needed to raise money, so they issued debt to finance that tractor factory. I have to get paid for the fact that John Deere, if I buy a 10-year John Deere bond, there is a slight chance, although a very tiny chance, that in 10 years, maybe John Deere won't be around, or maybe they will default on their debt. So the spread is how much I should be compensated for taking on the credit risk of John Deere. So if I buy a John Deere 10-year bond and the 10-year treasury bond is at 4.5%, I should be compensated for maybe a 1% more than that. So hopefully the John Deere bond would give me about 5.5, which is the spread, a 1% spread. But the bottom line is corporate bond traders, spreads are very narrow or very tight. And what that means is corporate bond traders don't anticipate any issues in companies moving forward. As a matter of fact, they think companies are in great shape. They have low debt, their earnings have been good. So you're not actually getting paid very much to take on that credit risk of investing in a corporate versus a treasury. So what that means is the bond market, which usually is good at sniffing out trouble, is telling us that they don't see any trouble on the horizon. And you know what? Maybe they're right, because the most fascinating fact, and I couldn't believe this, but in 2024, double B bonds, and by the way, double B falls below the investment grade bonds. Investment grade are considered generally pretty safe. Below investment grade is better known sometimes as junk rated debt. So double B bonds are technically in junk territory. They had no defaults in all of 2024. Now, on average, over the last 25 years, there's always been some defaults in junk-rated debt. As a matter of fact, about 2/3% of the time, or less, little less than 1% of the time, you do see defaults in double B bonds, but not last year. And that's one of the reasons why corporate bond traders moving forward are not rewarding us very much for taking on that credit risk, because apparently companies are doing quite well, especially given the low default rates. Okay, so looking at all that, what do we think is important to look at in both this quarter and then moving forward? And it's very difficult to kind of figure out where we want to be positioned, because there are arguments both for the bulls and the bears. The bulls are shouting at the top of their lungs that the new administration is pro-business, and that's going to be great for company earnings. And as we know, the market cares more about company earnings and profits than anything else. That's what drives returns. So if you've got less regulation, if you've got lower taxes, why wouldn't that benefit companies' bottom lines? So the bulls are very excited about that. And of course, they're still very excited about the potential for artificial intelligence to make companies more efficient, to drive higher margins. So that is really the bulls case, right? And to some extent, I do think it's very important to be exposed to kind of the benefits of this AI revolution. Although there's been some recent skepticism about if all that investment in AI is actually going to pay off. And that's actually sometimes what the bears say. You know, the bears are saying, wait a minute, you know, all that AI spending, I mean, are you sure that's going to generate the returns you think it's going to generate? The bears are also saying that inflation is still a problem. So, you know, a lot of the US and equity investors love when the Fed is cutting rates, right? Because that kind of puts wind at their back, because the stock market loves lower rates. That's, you know, that's less restrictive. But as we said, it might be a hard thing for the Fed to cut rates. I mean, even perhaps if inflation actually starts to creep up, maybe the Fed will have to raise them again. I don't think stocks would like that very much. The other thing the bears would say is that the current administration is wildly unpredictable. I think that's not too hard to argue with. And, you know, mistakes could be made. And if mistakes are made, you can be assured that the markets aren't going to like that. And the other thing that the bears can lean on is the fact that things are really expensive. I mean, a lot of the bears who've lived through the dot-com bubble bursting know that there are some similarities to what we're seeing today, right? Back before the dot-com bubble burst, you couldn't go wrong investing in tech, investing in telecom, until it all came crashing down. And when things correct, they tend to correct in a hurry. They don't just slowly go down. They actually correct in a big hurry. And of course, as we saw, with so many households having so much exposure to stocks today, if there's a lot of nervousness out there, there will be a lot of selling pressure. So if you're not really positioned somewhat defensively, it's going to be too late to be defensive by the time things start to correct. So, you know, those are some of the things that the bulls and bears are saying. I mean, the other thing is that, but that's also hard to argue with, is that, as we talked about, the consumer is still pretty healthy, right? And our economic growth in this country has been pretty darn consistently strong. That's always a good thing for company valuations, company earnings. You know, we'll have to see if those trends continue. And again, I always put my faith in bond market traders. And if the spreads are really tight, they're not really worried right now either. So again, you can make some nice arguments for both sides. So given the fact that, you know, there's some good bull market arguments and good bear market arguments, what does that mean for portfolios? Well, sometimes you got to just go right down the middle and stay relatively neutral, especially given the fact that it's hard to know which way things are going to go. On the equity side, we do think it's important to maintain a neutral exposure to equity, given your risk category that you're in. But within the equities, we do think it makes sense to lean towards areas that are less expensive. Meaning, if we can get more exposure to what I'll call equal weight in terms of index exposure, that's a better place to be than market cap weight based upon those valuation differences, right? We also think that it's not a time to be underweight international, because we want to lean more into what is less expensive, and international equity is less expensive. Now, for a while, we have been slightly underweight international. We now think it makes sense to be equal weight to international. And then within kind of our US equity exposure, we do think it makes sense to lean more into value-oriented stocks and away, when possible, from kind of that growth technology exposure, which we know is much more expensive than other areas. In terms of bonds, and you know, I was wrong last year about bonds. I thought bonds would have a better year than they did. They didn't have a bad year last year. They just didn't have as good of a year as I would have hoped they did, given the fact that the Fed was cutting rates. So instead of being overweight fixed income, we do actually want to remain neutral now on fixed income, given the fact that we don't really know if the Fed is going to be able to do much, if anything, this year. But you still are getting rewarded now for owning bonds much more than you did several years ago. And, in my example, if I can, buy a John Deere bond and collect, 5.25% with very, very low risk for the next several years, that's not too bad, actually, considering that that's way less risky than being exposed to, let's say, John Deere stock, which is much more volatile in its bonds. So, those are some of our thoughts in terms of what we're doing with the portfolios. And at this point, I'm going to move into Q&A. And I know that Katie will try and turn on, the voice option for those of you who might want to talk about questions you have. But in the meantime, I'm going to go some of the questions that you were kind enough to ask in advance. People did ask about the impact of potential tariffs from the Trump administration. We touched on that a little bit, but there's a lot of studies that show over the long term, tariffs are not inflationary, but in the short term, in general, they can be. And so if actually tariffs are implemented and that causes inflation to creep up, because basically things will be more expensive. I know I personally ran out and bought a lot more tequila, a few weeks ago when I thought tariffs were going to go up on Mexico, because everyone knows I'm a big tequila fan. Well, if we do see those types of tariffs come in, well, things are going to get more expensive and prices are going to go up, and that's going to cause inflation to go up. And inflation goes up, well, that's actually going to potentially be a problem, because then the Fed may be forced to actually raise rates. And if the Fed raises rates, I can guarantee you the market's not going to be happy about that. So, tariffs, depending on how they're rolled out, if they're not really truly just being used as a bargaining tool right now, I do think they might be inflationary. I do think they could raise prices. I do think it could cause company earnings to be hit. And so those double-digit earnings expectations that some of the investment banks think we're going to get in 2025, I think higher tariffs will make them harder to achieve. And if it's harder to achieve higher earnings, well, then the market is going to be disappointed, because the market is counting on higher earnings to justify its current lofty valuations. So that was a good question. Another one we had was, and I really love this question, any thoughts on retiring at the end of this year? My short answer to that is, if you are retiring at the end of this year, it is time to pull back from stocks, protect your nest egg a bit, right? Because hopefully your nest egg is a nice one at this point, thanks to the gains that we've had over the last several years. But if you are going to retire and that nest egg is something that you are going to need to draw upon during your retirement years, it probably makes sense to allocate away from stocks, just given how expensive they are, right? Again, you still can make reasonable returns in bonds, and you can always park a little cash on the sidelines, and if things get a little choppy, maybe you can reallocate back into stocks. And of course, I would never advocate being completely out of stocks, but I do think that if you're focused on preserving retirement funds, especially if you're retiring at the end of this year, now is not a bad time to rethink your allocation and potentially pull back from what could be a volatile year in the equity markets. Another question that came in, asked about, the economic environment on the whole seems to be at an extreme degree of uncertainty. I wouldn't disagree with that. And the question really went on to say, what are you thinking about in terms of how are you addressing that in the portfolios? Hopefully, I did a decent job of talking through that a bit. So hopefully I addressed that question, but that was a good question. Someone asked the top segments of the market to invest in this year besides AI. Well, first of all, I actually think, despite the fact that it's important to have exposure to AI, I'm actually not 100% convinced that you want to have overexposure to AI right now, given how expensive AI and AI stocks and anything related to AI is at the moment. That same person asked, is healthcare or pharma or biopharma a good place to be? And I would say, actually, if you look at the healthcare sector, the short answer is yes. On a relative basis, healthcare has been one of the most unloved sectors, right? When you have the market rewarding growth, rewarding tech, rewarding telecommunications, that's not healthcare. Healthcare was kind of left behind. So healthcare in general is much more of a value-oriented sector, right? So therefore, allocating a little more to what has gotten beaten up and what is much more value-oriented might not necessarily be a bad idea. And then someone else actually asked, what about gold? What about silver? What about Bitcoin? And I'll try and separate those questions into two parts. But in terms of gold and silver, well, many of you in our portfolios, especially on the more moderate to conservative portfolios, we actually do have some exposure to gold, and that is through the ETF IAU, which is kind of a play on the way gold is categorized on the periodic table of elements for all of you science majors out there. But anyway, we do think that it might have been a little prudent to have some exposure to gold. And gold, by the way, has been on a tear. It's been hitting all-time highs because gold is traditionally seen as an inflation hedge. I'm not the biggest fan of it in general because as an asset, it doesn't actually return anything, right? It doesn't provide a dividend. You're only buying it in the hopes of that it goes up. But nevertheless, it still has some practical value. I mean, gold is used in industrial processes. It's obviously used in the jewelry industry, and as governments, especially foreign governments abroad, start to get a little nervous about the current administration and about sort of the U.S. dollar and U.S. dollar policy and trade policy, gold has been another place that people have started to want to build up their reserves to, just to sort of diversify their exposure. So that's why gold has not been a pretty good place to be. Bitcoin, with the caveat that I would never advise anyone to put a lot of their money into Bitcoin. I think we have talked about how if you do have some, I'll call it money that you're play money, let's call it, where you're not afraid of losing it. Let's call it very high risk, a small portion that you're willing to put at very high risk. Getting exposure to Bitcoin isn't necessarily a terrible thing. I mean, certainly it's proven to be very lucrative for those who bought below it, at lower points before it's become literally worth $100,000 per Bitcoin. But I will say that it has no intrinsic value. It's only worth what someone else is willing to pay for it. And whenever you invest in something like that, it can be very dangerous if the sentiment turns negative, because there's no inherent underlying value to it. It's really just right now, there's a lot of people who think it's worth something and they're buying it accordingly. So, but the future is still cloudy. And if you are going to get exposure to it, I actually prefer direct exposure. In other words, buying it directly as opposed to buying it through a derivative like an exchange traded fund. And I'm happy to talk to any clients in more detail about that, separately. But those are some of the interesting questions we got sent in advance, and we appreciate that. But in general, I hope that was interesting. At least we love to hear your feedback. We did appreciate those questions we got in advance. Katie, always appreciate your help. And with that, I hope everyone has a really great rest of the week and weekend.
Yeah, that's great. Thank you, Steve. Thank you again for everyone who joined today. Look out for the recording in your inbox in the coming weeks. And as Steve said, please give us some feedback. So our next call is scheduled for May 15th. So look out for that to your inbox as well. Thanks, everyone. Enjoy the rest of your day.